This is a tutorial on how to deploy liquidity in decentralized finance and across decentralized exchanges. For the sake of this example, we're going to do a tutorial on Uniswap. So let's dive right into it. First things first, this is an educational walkthrough. It's absolutely not an endorsement of Uniswap and the pairs that I am about to share with you here. Second, if you're doing this for the first time, I highly recommend you start with small amounts so you can understand how liquidity provision functions and you get comfortable with the user interface and experience. And then after that, you can gradually increase the amounts. Third, it should be intuitive by now. Always double check the URL and ensure that you are on the official DEX website so you avoid phishing attacks. And definitely always bookmark the URL so you don't have to search for it every single time you need to access that specific protocol. Finally, and before we dive into the actual deployment of liquidity, I want you to know that liquidity provision is an advanced DeFi strategy. It's way more advanced than staking, than liquid staking, than lending or borrowing. So definitely this is not a passive strategy. This is for sure an active strategy. You will have to continuously monitor your position, especially if you are using concentrated liquidity and know exactly what you're doing and have time to regularly check on your position rather than just set it and forget it. With that out of the way, we can dive into our tutorial. So we are on Uniswap here. In order to deploy liquidity on Uniswap, the first thing that you need to do, and you need to explore the available pools that are on Uniswap. So you go to explore, you click on pools, and here you go, you have all the available pools listed. So here on the top, you can basically filter. Instead of having all networks, you can choose the network that you want. You can choose the protocol v4, v3, v2. Obviously they differ between one another. There is big changes between each version. Obviously each version allows for better user experience, better setup for liquidity providers, and of course, in order to attract more and more liquidity into the protocol, and at the same time, better execution for the trader or for the investor that wants to swap assets. So, for the sake of our example, we're going to go with V3, and along the way, I will briefly explain the difference between the settings in V3 and V4. V2, we're going to skip it because it's a bit outdated. We're not going to be using it anymore. So right now we're going to be doing an example on the base network. We're going to take ETH and USDC pool and deploy liquidity into that pool. Now, when you are browsing or when you are exploring the available pools, you can see on the dashboard the different statistics or metrics of that specific pool. So here you see which protocol this pool is in. So our example is going to be on V3. The fee tier, this is zero point 0.3. So the fee tier is the percentage that is charged on every swap in that specific pool, which gets paid obviously to liquidity providers like us in proportion to our share of in-range liquidity. So this pool charges 0.3% in terms of fee tier. That's the default if you want. And then you have the total value locked. So this pool have $135 million sitting in it, which is, I would say, the biggest pool on the base chain on Uniswap. Of course, if I navigate to Ethereum, for example, you might see a much different TVL, the pools with or other pools with higher TVL, such as, for example, in here you have Wise and Wise ETH pool have higher TVL than ETH USDC. So to go back to base, so this is the total value locked, the pool APR. So this is the expected yearly return from obviously the fees that traders pay. Reward APR is not available for any of the pools. 1 day volume 34 million, 30-day volume 1.7 billion for that specific pool. Definitely a very big volume, which is very good. And then 1 day volatility per TVL 0.26. One thing I would like to highlight here, the most important metric for you is the pool APR. You need to see if the return that you are getting for providing liquidity outweighs the risk of impermanent loss. As you know, we talked about impermanent loss in the lesson. Impermanent loss is simply the opportunity cost of you holding the tokens versus you putting those tokens inside of a pool. Because keep in mind that when you put tokens inside of a pool, you're effectively giving your tokens to the market for investors to use them to swap from one asset to another. So if you're deploying ETH and USDC and someone wants to change USDC into ETH, they will take your ETH from the pool and replace it with USDC. So obviously, if you're not getting enough returns for that specific pool or for the specific pair that you want to choose, then you will have a bigger impermanent loss than the return you will get from the pool. Now, it's very difficult to know what the impermanent loss might be. It all depends on the volatility of the pair that you are providing. And in our case, ETH USDC is definitely a volatile pair. Why? Because USDC is stable, Ethereum jumps up and down, and it is a volatile asset. For example, if I choose another pool which is ETH and let's say Pepe, there might be less impermanent loss. Why? Because ETH and Pepe are somewhat correlated. When the whole market falls down, both tokens goes down. When the market goes up, both token generally goes up. Obviously, this is not a rule. This is just for the sake of example. So the fact that I am choosing ETH USDC as a pool means that I have one token which is stable and another token which fluctuates, making impermanent loss even a bigger risk for the example we're about to give. So if I am not comfortable with 28% APR, because I believe that Ethereum in the near term is going to be very volatile, then I should not enter this pool. But if I do believe that we are entering a period of consolidation and I do not expect Ethereum to move much in the next weeks to months, for example, then it makes sense to choose this pool and deploy my Ethereum that's sitting idle in my wallet in order for me to generate some returns from the fees. So this is how you basically read the dashboard and why understanding the APR on that pool is extremely important. So you click on the pool. That's the one here. You can see all the volume that's available, or the fees, basically. Sorry, not the volume. As you can see here, this is the hourly volume. You can obviously zoom out to weekly, monthly, yearly. This is the volume. This is the price of the token. This is the liquidity that's available. And as you can see here, liquidity is concentrated in the middle. This is the current price here. You can see it's split between blue and gray, which represent USDC on one side and Ethereum on another side. This might be a bit confusing for you right now, but in the next slide, when we deploy liquidity, this will all make sense to you. Transactions, total value locked, volume for that specific pool on a daily basis, and the fees as well. So this pool generated $103,000 in a matter of a day. So let's say if you provided liquidity and your liquidity share from the total pool represent 1%, or let's say 10%, if the pool is making $103,000 per day, you will get around $10,000 if you supply 10% of the liquidity. So obviously these are huge numbers. This is just for the sake of example. So, and this also shows you how much there is from both pair in the pool. So you have right now 39,000 Ethereum and 46.6 million USDC. And the total APR is around 28%. So if you want to deploy liquidity, obviously you click on add liquidity. So this is the first step. So here you can choose the different versions, be it V2, V3, or V4. We're going to skip V2, of course. V2 does not allow you to choose a fee tier. It is automatically set at 0.3%. V3 allows you to choose the different fee tiers that you would like to charge, and then V4 as well with a bit more with different perks if you want, and different settings as well. So for this example, we're going to be going with V3 here. The assets that we want are ETH and USDC. So as I explained previously, a fee tier is the percentage charged on every swap in the pool, which gets paid to liquidity providers like us in proportion to our share of in-range liquidity. So it's basically the fee that traders pay in order to swap their tokens using that specific pool. Why there is multiple different fees? So on Uniswap V2, there was only one fee, and that was 0.3. So if I click on V2, you can clearly see that there is only one fee, which is 0.3. But to make things better, to make the user experience better for the trader and also for the liquidity provider, the team behind Uniswap decided to start including fee tiers. And depending on liquidity conditions, then the Uniswap protocol automatically routes the transaction of a specific trader to a specific fee tier, depending on the liquidity that's available per fee bracket, if you want. So again, in V2, there was only one tier that was 0.3%, but in V3, Uniswap introduced multiple fee tiers, so the fee could match the risk and behavior of the asset pair. The idea is pretty simple. More volatile pairs need to charge a higher fee to compensate LPs for impermanent loss. And very stable pairs can charge less because the impermanent loss risk is much smaller. So, as you know, the more volatile the tokens are for that specific pool, the bigger the risk of impermanent loss. So Uniswap decided to create fee tiers to compensate liquidity providers in the event of very volatile pairs. So why? Because if there is a very volatile pair, then the fee is supposed to be high, and it should be high enough to compensate the liquidity provider for the impermanent loss that they will incur for providing liquidity. So that's why they introduced the fee system. So for volatile pairs, as you can clearly see here, you should choose something with very high fee rate. So here you have 1%. This is best for exotic pairs, meaning extremely volatile pairs. 0.3 is the default if you want. This is best for most pairs. 0.05% is best for stable pairs and mainly stable coins. And 0.01% is even better for stable coins than 0.01 because they are extremely stable. So here you depend more on volume. There is a lot of volume coming to the stable pairs pools, which obviously compound fees and makes it worthwhile to deploy liquidity in stable coin pools. While on the other hand, if you have volatile pairs, you have a lot of impermanent loss, then you charge a high fee so that you get compensated for the impermanent loss that you're gonna basically get by providing this liquidity. So there is a real trade-off that LP providers need to understand before they deploy any liquidity. Higher fee tier equal more fees per swap, but fewer swaps because traders route to the cheaper pool when they can. You earn more per trade, but capture less volume. Lower fee tier, on the other hand, there is less per swap, but more volume because traders prefer cheaper pools. You earn less per trade, but more trades happen against your liquidity. So the right fee tier is the one where the fee and volume math wins for that specific pair. And this is, of course, something you have to research, do your technical analysis on, and then decide on. One important thing also to highlight here is that behind the scenes, what happens when a user click on swap? So when you swap on Uniswap, you don't just pick the fee tier yourself. Uniswap Auto Router does this for you. It scans every pool for that token pair across all fee tiers and even across Uniswap versions, then routes your swap through whichever path gives you the most tokens after fees, price impact, and gas. So the user doesn't pay a fee tier directly, they get the best net price the router can find. This is why fee tier selection matters so much when you provide liquidity. You're competing with other LPs for the router's attention. The router sends volume to whichever pool gives the best execution, not whichever pool charges the lowest or highest fee. So this is very important to understand. So for this example, we're going to go with the default, and that's the 0.3%. There is currently $134 million of liquidity sitting in that pool. And at the moment, there is around 57% of all swaps that are happening getting routed to that specific pool. While, for example, if we choose another pool, which is 0.05%, currently there is only $100 million in total value locked or total liquidity sitting in that fee tier, and then only 42% of all the swaps are happening on it. So obviously, choosing the 0.3% makes much more sense when it comes to the math and the amount of fees that you might collect for providing that liquidity. So we're going to be choosing 0.3. I continue. And then this step is where I choose where I want to deploy my liquidity. So what do you see here? First of all, you have two tabs. You have full range and you have custom range. If you choose the full range, then you are deploying liquidity for the full price range of Ethereum, meaning you are deploying all the liquidity for the full range of the price of Ethereum. So if I zoom out to the 1 year, you can clearly see that our liquidity will be concentrated in the middle, but there will also be a portion of our liquidity spread on the edges, When I say on the edges, this is the top of the price of Ethereum. You can clearly see this is the price chart. This is where Ethereum topped on August 22, 2025 at $4,817. So if we deploy liquidity, our liquidity will be sitting all the way to around $5,000 per Ethereum. And at the same time, we also have liquidity dropping down to around $1,000 of as a price for Ethereum. So you're going to be having some liquidity sitting at the edges, not doing anything, sitting idle. And this liquidity will not be earning any fee. So a better approach would be to choose to concentrate your liquidity and choose custom range. And when you choose custom range, you have the option to change where your liquidity will sit. So if I expect Ethereum to consolidate in this range, let's zoom in, for example, here. If I expect Ethereum to be consolidating in the current range for a period of a week or two, for example, then I might deploy all my liquidity in this specific range. And while Ethereum is just chopping sideways in that specific range, I will be putting all my liquidity and all my deposited tokens to work, and then they will be used by traders. And the more they use them, the more fee I collect. But obviously, choosing a custom range requires a more active approach. If you want, in order for you to anticipate what the price of Ethereum or the token pair that you chose will do in the near future, you need to be doing technical analysis. You need to see the market. You need to forecast and speculate where the price of these assets will go in the near future and deploy your liquidity accordingly. So this is definitely an active approach if you decide to choose custom range. But if you decide to opt for a full range, then you just set it and forget it. But obviously, you're not going to be earning enough fees. And at the same time, you might have impermanent loss where you might, in this case, for example, lose all your Ethereum and end up with USDC only, or lose all your USDC and end up with Ethereum. So this is obviously something that you need to understand. Why am I saying this? Because when you deploy your liquidity, be it full range or custom range, and traders start swapping tokens from your pool, as the price of the assets of the pool starts fluctuating, they will start to take a portion of your provided tokens, and that's why the quantity of tokens will differ. Let's take a real example. So these are the, if we choose the custom range, of course, these are the options that Uniswap provides you, but you can also adjust them to best fit whatever you want. So right now we are zoomed out on the 1 week, and we can clearly see that the price of Ethereum for the past week have been ranging between 2,373 all the way to the current price, which is around 2,262. This is where the price range of Ethereum is sitting. So if I need to deploy capital, here I can choose for Uniswap to automatically split my liquidity for +2% and -2% of the current price range. So you can clearly see that my liquidity have been deployed here. This is where my liquidity will be sitting, and I will be making fees as long as the price range stays in that range. Obviously, I can change that range the way I want. So I can expand it to the downside, I can expand it to the upside. I can also provide one-sided liquidity. Instead of providing Ethereum and USDC into the pool, I can only provide Ethereum. So here, if I deploy liquidity here, I'm only providing Ethereum. If I scroll down, you can clearly see I can only deploy Ethereum. If I move this down, I can now also provide Ethereum and USDC. And if I want, I can also reduce this to only supply USDC, as you can clearly see. So this is called one-sided liquidity, and I can also do that. And the traders use one-sided liquidity to enter and exit positions. Why? Let's say I decide to provide one-sided liquidity to the upside. So when I deploy liquidity in this price range, I am only deploying Ethereum, meaning I took my ETH and I put them in this price range inside of the pool. As the price of Ethereum goes higher, the pool will automatically take or swap my Ethereum token into USDC token. Therefore, I will lose my Ethereum tokens and they will be replaced by USDC, which is effectively swap. I'm just swapping from Ethereum to USDC in this example because we are on the ETH USDC pair or pool. So if I'm deploying single side liquidity to the upside, as the price of Ethereum keeps on going higher, it will automatically start removing or swapping my Ethereum for USDC. So this is why some traders do trade using single sided liquidity. instead of just swapping or placing a market or limit order on an exchange, what they can do is, if they expect the price of Ethereum to go to a certain level, or they want to exit their position at a specific level. Let's say in our example, they want to exit at a price of between 2,262 and $2,330 for an Ethereum. They deploy all their liquidity, all the ETH that they have in this price range. And as the price starts climbing higher, they will automatically start switching their Ethereum into USDC, effectively exiting their position, and at the same time collect fees while they do so. And the opposite is true. If they want to enter a position, rather than going to an exchange and buying Ethereum and swapping your USDC into Ethereum, what you can do, you can deploy a single-sided liquidity to the downside. So let's say I expect the price of Ethereum to fall 3% in the coming few days, and I want to enter a position. What I can do, I provide single-sided liquidity, which is USDC in this case, with a price range or with a price bracket of -1% to -3%, and I just wait. If the price of Ethereum starts going down to the price range that I am in, then it will automatically start swapping my USDC into Ethereum. This way, I will be able to enter a position and at the same time accrue fees. Obviously, these strategies are active strategies. You need to do technical analysis. You need to be a trader. You need to have time to analyze the market and see where the price might be going, and then create your strategy of entering or exiting accordingly. Or if you don't want to enter or exit, you can just provide a two-sided liquidity to the upside and to the downside, especially if you expect the prices to consolidate for the next 1 or 2 months, let's say. You can provide liquidity in a specific price range and just let it sit there while the price consolidate in the same range. And as the price consolidates, you are printing fees basically, and you are making money. So let's continue with our example. For me, at the moment, for the sake of example, I'm just gonna zoom in at the 1 day price range. I'm gonna move my liquidity to the upside. This is the liquidity that I would like to sit in, or put my money in. +1% and -1% from the current market price, which in this case it's 2258. So I'll be deploying my liquidity between a price range of 2235 and 2280 for Ethereum. If the price of Ethereum goes above 2280, then I will replace all my Ethereum into USDC and I will end up having my full position in USDC. If the price goes down, I will switch all my USDC into Ethereum and I'll end up in Ethereum. And if the price just consolidate in that range, I'll keep on printing money, while printing fees and making fees, while the balance of my tokens fluctuates depending on if the price is going up or down. So this is the range I decided on. I'm gonna be putting my as much as I can in terms of liquidity. Obviously, I cannot put all the liquidity at the moment, or all my Ethereum, because I will have to have an equal amount of the second pair, which I don't have in my wallet at the moment. So I'm gonna reduce my liquidity to the to maximize USDC, which will and automatically I will have almost the equivalent amount in Ethereum. As you can see, the amounts are not exactly the same. The reason behind that is because my bins or my liquidity range that I chose is also not the same. So here I have I'm deploying liquidity to plus 0.79% while -1%. So I need more USDC to be deployed to the downside, because I'm expanding the range slightly by 20%, the upside range, if you want. So that's why you don't see an equal amount here. So for example, if I increase this one bin, so it's right now 1.4%, you can clearly see that this has increased. It's no longer $8. I stretched the range on the top, so I need to add more liquidity to be able to cover all the bins on the top. So I'm going to reduce it back. This is the liquidity. Okay, I agree. This is my final position. You can clearly see where the liquidity is, where I'm putting my liquidity. And minimum, this is the minimum price range, 2235, maximum price range, 2275. This is where my liquidity will be sitting. This is the amount that I will be depositing. This is the network cost, and I click on create. I sign the transactions. Okay, confirm. So I have to approve first and then confirm again the deployment of two transactions. So the first one approved. That's the second one right now. I confirm. And I think my position is created right now. So you can clearly see it here. This is my position, $19 total, or $20 almost, the total position in range at the moment. So as the price fluctuate in the price range that I put, I am basically making fees. So on this dashboard, what do you see here? You have migrate liquidity if you want to move your liquidity to another pool, add liquidity if I want to add more, remove my liquidity, and collect fees. So these are the fees that I have earned so far. Because the price is currently inside of my range and it's going down, it is switching my USDC into Ethereum as if I am buying Ethereum. This is where you can start seeing the concept of impermanent loss. So as the price fluctuates in the price range that I put, then my token numbers, or my token quantities, will start changing depending on if the price is going down or up. So in this case, when I switch my Ethereum and my USDC into Ethereum, and if the price keeps on falling lower, this will cause an impermanent loss for me. If the price reverses back to the same range of liquidity I was in, I'm good. The losses will be reversed. But if it doesn't, if the price keeps on falling lower, then what happened? I switched my USDC into Ethereum and the price kept going lower. So right now I have an impermanent loss. If I did not put my liquidity into this pool and I kept holding my USDC rather than converting them into Ethereum, I would have been better. So this is the concept of impermanent loss, and you can clearly see it in front of you. So these are the fees that I have earned. Of course, this does not refresh very quickly, so maybe we'll give it a refresh here to see if I collected more fees so far. So here you go. Right now, I did collect more fees. You see that I collected so far 0.00352. I have right now less ETH in the pool and more USDC. So the price is going higher for Ethereum right now, and it is switching my Ethereum into USDC. So this is how you basically deploy liquidity. If you want to remove liquidity right now, you just click on remove liquidity, max. You choose max if you want to remove all your liquidity, or 50% if you want to remove half of it. In our case, I'm going to remove all of it. Withdraw as is. So I'm going to remove this because I want to withdraw as Ethereum and USDC as well. And I will also remove the fees that I have earned at the same time. I review, I confirm, confirm. So liquidity has been removed. If I open my wallet right now, I can again see the tokens available in my wallet again. So this is how you basically deploy liquidity into decentralized finance, specifically on Ethereum.